Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin economic calendar, the news and analysis that you need to know for the week ahead in Bitcoin. Today is Monday, January the 18th, and we have an action-packed week in the markets coming up. We have corporate earnings kicking off in the United States this week, and we also have President Joe Biden getting inaugurated this week. We're going to talk about what the implications of those two events can be for Bitcoin, and we're also going to talk about double-digit asset price inflation in the United States. We're going to look at what that means and how that may be driving investors to explore investments in areas such as Bitcoin. So lots to cover today. Onwards to our analysis. So starting as we usually do with Bitcoin, we see that last week Bitcoin actually had its first down week in a long time. It was down 6.16% for the week, even in the context of very favorable news flow. So during the week, we saw industry-related headlines from none other than the Federal Reserve and Goldman Sachs. So we're going to talk about those two briefly. Here we see that on Thursday, the Fed's Jerome Powell said that stablecoins are a high priority and that they are looking at it very carefully. They understand that stablecoins can become systematically important overnight, and they want to get their arms around the potential risks and how to manage them. However, they did mention that they want to do this right rather than quickly, and that the time for action would be measured in years, not months. It is interesting that the Fed is now paying attention to stablecoins, and even more interesting that they want to get it right. So the other headline that we were mentioning was that on Friday, CoinDesk reported that Goldman Sachs is said to be planning to enter the crypto market soon with a custody play. It did also mention that JP Morgan and Citi are also looking at this as well. And the Goldman Sachs source in the article also said that the firm does not have grandiose crypto prime brokerage plans like the ones that Coinbase, BitGo, and Anchorage have. Now, just going back to the price for a second, looking at Bitcoin's price action, we see that it did have a down week last week. We also see that Ethereum had a down week last week. This illustrates just how much noise there is in the markets compared to the performance of, say, the DeFi index, which we have here and we'll be covering at length later in the show. So this just illustrates how much noise and speculative action is in the markets at the moment, and we'll discuss what the options markets are showing for Bitcoin's January 29th expiration, along with what the futures markets are showing in our What's Ahead section later today. Now, moving over to the S&P 500, we do see that the S&P 500 also gave back 1.48% last week to close at 3,768 points, which is just 4 points away from where it started the week prior. As we can see here, the point at where it ended the last week was very similar to what's just 4 points away actually from where it started the week prior. What this means is that essentially the S&P 500 is flat for the first 14 days of January or 2021. And with so much going on this week, it makes sense that the market would take a breather. We have a decisive week ahead for U.S. equities with the start of the fourth quarter earnings season this week. And throughout the week, we actually get to hear from some very large banks like Goldman Sachs and Bank of America, along with some tech darlings. And we'll be covering those in detail in our What's Ahead section below. But interesting to keep an eye on is to see if any of these bank earnings calls do mention the word Bitcoin this time around. Silvergate is scheduled to report this week, which will definitely highlight Bitcoin in its report. Now, as we'll cover in our market trends section for the S&P 500, the price to earnings ratio for the S&P 500 has been expanding dramatically over the last year. And this earnings season can be a catalyst to either compress or expand those multiples based on corporate results and guidance. Now, last but certainly not least, we have the inauguration of President-elect Joe Biden this week on Wednesday, which should be a very momentous occasion in the United States. And President Joe Biden is already working on a $1.5 trillion spending program to stimulate the U.S. economy. So once the celebration is over, investors' attentions could potentially go right back to the stimulus spending, which, as we've seen, has driven the markets higher on the narrative of potential future inflation. Moving over to gold, we also see that it had a down week last week alongside Bitcoin and US equities, but it did hold up a little bit better, just giving up 1.13% to close at $1,827 per ounce. Similarly to US equities and Bitcoin, investors are potentially awaiting some of the decisive actions from this week to help drive further investment decisions. The next catalyst for gold could be the fiscal stimulus that will certainly arise, or the conversation around fiscal stimulus that will certainly arise after Biden's inauguration in the coming weeks. We'll see how gold performs to Bitcoin, or relative to Bitcoin, to the upside, if this does pan out. And furthermore, it is interesting to note that gold, US equities, and Bitcoin were all down last week, which, as we'll see below, is not the same performance that the DeFi index have, and alongside with all the highly speculative tokens, which were also up. These market dislocations are important to look at because they can tell us a lot about the dynamics and behavior that we're seeing in the markets. So moving over to the DeFi index, we see some very interesting price action over the last week. Euphoria has squarely taken over the alternative coin markets, with the DeFi index soaring 31.11% last week. Now, it is interesting to put this all into context. DeFi soared 31.11% in a week when Bitcoin was down 6.16%, US equities were down 1.48%, gold was down 1.13%, and even Ethereum was down 1.75%. DeFi, defying the trend, essentially rose by 31.11%. Now, on top of that dislocation in price action between the other protocol level assets and DeFi, we see some other troubling news throughout the week for the sector, which is what you see below in my screen right now, which is that Andre Cronje, who is the godfather of DeFi and fair launches, or seen as the godfather of DeFi and fair launches, and the creator of YFI, published a piece that was literally titled "Building on DeFi Sucks," which went on to say that he had made many mistakes and did not suggest founders follow the path that he followed, at least for his token launch and the development process of his project. For context, Andre's YFI concept was largely responsible for triggering the previous rally in DeFi. Now, what we will also see is that in addition to these two things, a law from the US Treasury is potentially days away from potentially outlawing any services that do not properly KYC their users, which is basically the large majority of DeFi projects. Now, all of this, just going back to the price chart, all of this should make investors take a pause and deeply consider the market conditions that we are in. While we're not trying to discard every single DeFi project as valueless, given the recent market activity, there is little reason to believe that the recent price run-ups are long-term investors who truly believe in the world-changing potential of DeFi. Have you read a single institutional investment thesis as to why they are allocating investment dollars into DeFi? Neither have we. So all of this could translate into continued volatility for Bitcoin and digital assets in general for the weeks to come. So in today's market trends section, we're going to look at double-digit inflation in desirable US assets and what that means. So inflation can take many forms and can be hard to identify. But if you know where to look, inflation is already at play and dealing a huge blow to the wealthiest class of investors in the US. Today, we're going to look at price inflation over the course of 2020 in three asset classes. One, retirement cash flow through AAA corporate bonds. We're going to look at the AAA corporate bond yield. In essence, we'll talk about this in more detail about what these three mean. We're also going to look at the price to earnings ratio of US equities around the same period, and we're going to look at the price of luxury real estate around that same period. Now, just to get into what each of these means in more context. So the first one would be the cost or the price or cost of a retirement cash flow of $120,000 per year through investments in AAA corporate bonds in the US. In other words, this essentially means how much does an investor have to have saved up to invest in bonds at retirement to get a cash flow of $120,000 per year for his or her retirement. The second item that we're going to look at is the relative cost of US equities, comparing the growth in their share prices with the growth in their earnings. Meaning that if the share prices are growing but the earnings are not, then the share prices are going up without the underlying fundamentals doing the same. For further clarity, this means that the price of stocks are becoming more expensive, not because they're generating more money, but just because they're worth more in nominal dollar terms. Now, the last thing we're going to look at is the average sale price for luxury real estate in the Hamptons, United States. This is a very popular area for very wealthy New Yorkers to purchase detached residential real estate. We use the Hamptons as an example as it is widely known that wealthy New Yorkers think very highly of homes in the area, and furthermore, these would be homes where they could go and spend the pandemic more comfortably. So to set the stage on both of these, it's important to look at what the U.S. Bureau of Labor Statistics defines as the U.S. Consumer Price Index and what that did over the course of 2020. So what you have on the back of your screen right now is the National Bureau of Labor Statistics, which shows us that from February 2019 to 2020 to February 2020, price actions rose by 1.4%. So price actions rose by 1.8%. I believe I have the one. I had the your consumer price index from 2020. Yeah, that is correct. Sorry. So the from February 19 to February 2020, the consumer price index rose by 1.4%. Now, when we compare this to the other assets that we're going to be looking at, we have a very different picture. So first, let's look at the price of $120,000 a year retirement cash flow through investment in AAA corporate bonds. So as we can see from the chart here, the yield on a AAA corporate bond at January 2020 was 3%. So the person that would invest in AAA corporate bonds at the beginning of the year would have received a return of 3%. If we fast forward to what the return was on January 4th, essentially 2021, that has gone down to 2.54%. So what does this mean? It means that if a person wanted to receive $120,000 cash flow at the beginning of 2020, then they would have had to have an investment of $4 million saved up to invest in bonds. This would give them that $120,000 a year cash flow. By January 4th, 2021, the cash flow from that $4 million investment in bonds actually would have gone down from $120,000 a year to $91,200 a year. In other words, if that investor wanted to keep the same $120,000 cash flow annually, he or she would now have to invest $5.263 million in the same bonds. This represents an increase of 31.58% for the year, more than 20 times the increase in the CPI reported by the United States. You can think of this as the price of that $120,000 cash flow per year through high quality US bonds. That price has gone up 31% over the course of 2020. Now, that's pretty dramatic, but now let's look at the S&P 500 price to earnings ratio. So the chart that you have here is essentially dividing the price of the S&P index over the earnings of the companies that are in that index. So as we have covered in the economic calendar extensively over the course of the last few months, the S&P 500 has made new historical highs over the course of 2020 and more recently in 2021. Now, while the index itself has increased from 3,257 points to 3,700 points, let's just look here at the increase of the S&P 500 on the chart. So over the course of 2020, let's just go back to the beginning. So here is the beginning of 2020. December 30th, it was at 3,200 points, closed the year at 3,700 points. So that represents an increase of about 13.59% over the course of 2020. Now, the increase in the price of the index does not tell the whole story. If the share prices went up by 13.59%, then that means that companies in general should be making about the same more in profits, therefore making them more valuable. To see what's really happening, we need to look at the price or at the earnings that these companies are generating and how those have changed over the course of 2020. When we go back to look at the price to earnings ratio of the shares of the index, we see a very different picture. the PE ratio, which is what's in short what you refer to as the price to equity ratio, the PE ratio for the S&P 500, as calculated by the Case-Shiller index pictured behind your screen, shows that the PE ratio from the S&P 500 has gone from 24.21%. So we're going to look at it here. 24.88% January 1st, 2020 to 37.85% on December 31st, 2020. So this means that the price of the index has actually risen despite the earnings for the underlying companies not growing by the same amount. And in some cases, these earnings may have even shrunken. So the PE ratio for the S&P 500 has actually expanded by 56.34% over the course of 2020. This is more than 4 times the rise of the index itself and over 30 times the rise of the consumer price index that the National Bureau of Statistics publishes. Now, let's look at luxury real estate. So, to illustrate inflation in the United States or U.S. real estate, the best example is probably found in markets that the ultra-wealthy in the United States are competing for. Single detached homes in the most luxurious neighborhood around the New York area, the Hamptons, is a good example. While the most recent reports from real estate activity in the area date back to the end of October 2020, the price action up to October 2020 was so dramatic that makes paints a pretty clear picture of what's happening. So looking at these real estate reports, at least from this headline from CNBC, we see that the average sale prices in the Hamptons soared by 46% in the third quarter of 2020, according to a report from Douglas Elliman and Miller Samuel, which are 2 brokers in the area. Now, if we also look at other reports, for example, this one here that is from Saunders and Associates, it shows that the median price for all houses in the Hamptons, or all Hamptons, was up 40%. For Q3 2020, and the dollar volume increase in sale activity was actually more than doubled. So quite fascinating stuff that we're seeing in some of these assets. So as a summary, we can see from the data above that the real inflation that wealthy market participants are perceiving is far, far away from the number that's published by the National Bureau of Statistics. This is very helpful in understanding why so many high net worth individuals are looking to protect their wealth and exploring alternatives such as Bitcoin to find refuge for their savings. Now, with a $1.5 trillion spending program potentially around the corner, this trend does not show any signs of slowing down, so it's something to keep top of mind. Moving over to our Bitcoin mining difficulty commentary, we see that not much has changed on this front since last week. We are still at our all-time high for difficulty of 20.61 terahashes, and our next difficulty adjustment is projecting an increase to 21.9 terahashes and a new all-time high and an increase of 6.27% in the difficulty. Now, the next adjustment is projected to come in on Friday evening or early Saturday morning. Despite the added hash rate operating at the moment, the mempool is quite built up at the moment, so transaction speeds may be slower than usual and more expensive to process, so something to keep in mind as you prepare your transactions for the week. So as always, we leave you with what's ahead for the week. As we mentioned, we have 2 very relevant events going on in the United States this week. First, we get the long-awaited Joe Biden presidential inauguration on Wednesday, and we also have U.S. earnings starting in earnest this week. On tap, we have Bank of America, Goldman Sachs, Netflix, and Silvergate on Tuesday, along with others. We also have Morgan Stanley and others on Wednesday, Intel and many more on Thursday, and some others on Friday. As we mentioned above, the price-to-earnings ratio of the index and equities in general has been expanding, particularly for the S&P 500. This round of earnings provides an opportunity to see if corporate earnings can start catching up to these valuations. Some analysts are predicting that the market may be underpricing a potential upbeat outlook from several sectors in this round of earnings, something to keep in mind as we enter earnings season this week. As far as Bitcoin goes, the price action that we're seeing is consistent with the speculative action around the crypto markets in general with the volatility. The DeFi index grossly outperforming not only Ethereum, Bitcoin, but also gold and U.S. equities last week is a telling sign. This, as we've discussed, are the typical things you see in an overheated market. And on the options side for Bitcoin, there's a large open interest position at the $52,000 strike for January 29th on Deribit. We've discussed here in the past that these large option tickets can create some buzz and sometimes create a certain gravity around them, so something to keep in mind. We also saw that the Grayscale Bitcoin Trust opened up again for purchases or contributions last week, and that within 24 hours, it saw an increase of 5,132 Bitcoins, or around $189 million. Earlier this week, Grayscale had announced that it closed the year at $20.2 billion under management, up from $2 billion at the start of the year. It went on to say that the growth has been driven by demand from institutional investors such as hedge funds, endowments, and pension funds. The reopening of contributions could potentially act as a catalyst in the coming week for Bitcoin. However, investors should operate with caution as the signs of volatility are all around us. Now, we will also have some very exciting updates to share from Lennon throughout this week. And as always, we will keep you posted of any relevant news throughout the week right here and in our social media at HODL with Lennon. If you don't yet have a Lennon account, I welcome you to check out lennon.io and see how you can start earning 6.25% APY on your Bitcoin and 12.25% APY on your USDC. Thank you, everybody. If you liked it or learned something today, I invite you to like it and share it. Hope you have an excellent week and see you next time.